This is what happens when you don't understand what the market has done previously. You completely ignored the swing points, and you've bought a downtrend when the market already told you what's coming, but you missed it. By just looking at what this market's swing levels are forming, you should be able to identify what trend the market has followed. This helps us in knowing with a higher accuracy what would be the most probable direction it is going. For example, we've seen here on the left, an increasing market formed with higher highs and higher lows. So it's essentially just an uptrend. So during these days, what we should be doing is waiting for the market to pull back into the previous low, so we can look for buying opportunities to take the market into a higher high. This happened multiple times. It's the most simple approach of just buying pullbacks in an uptrend. But if you keep doing this forever, well, eventually the market will have to turn bearish as well. What comes next? The market trying to push into the highs, but failing, not having enough strength. So before we've had an uptrend, and because we've now broken the past low, we no longer are in an uptrend, because it doesn't respect the structural rules of a higher low. Here, we're having a lower low instead. It's really mostly about identifying the swing points, as they're what decides the trend the market is following, and we do nothing but just have patience and simply just following the trend. So now that we've got a market structure shift, the swing points reverse, the market now having pullbacks with the lower highs, which are there mostly to fill a supply, a resistance or a bearish imbalance, just to reject back down, with the lower low forming a break of structure on this time frame. After a bearish break of the previous swing point, a pullback will often form, similar to what we've seen here, where we've had the trend shift, and then we got a pullback to the upside that later faded down. It's what we should be expecting to happen again. The pullback filling a supply or resistance, so the market can later continue the downtrend. Now, of course, this won't keep happening forever, because we will eventually see a reversal once again. But trying to predict the exact moment of a reversal is a lot harder than just following what the trend is already printing on the chart. So as I said, because of the last break of structure, the market has a high chance of reversing to the upside in form of a pullback. The pullback usually ends up on a supply or resistance, so we need to identify a supply or resistance near this range, which is basically the most recent price action, being a pullback here, followed with a downside break. Now expecting once again a similar type of price action, the supply is identified as the last bullish candle before the downside impulse started to happen. That's very simple to identify in this chart. That's this candle right here. So the supply is taken from the whole candle, including the wicks. The price is approaching the supply, and when it's getting closer, we want to refine this supply by lowering down time frames so we can see the exact moment the supply will fill. The time frame you enter doesn't matter that much. It doesn't need to be that specific as long as it's lower than the initial time frame. In this case, I've chosen the 1-hour chart. And once we've entered into the lower time frame, we do a quick analysis of the swing points. Here, it's quite easy to see that we have lower highs and lower lows, so essentially a downtrend. We have two possible outcomes. The market breaking above the previous high, which would reverse this low time frame downtrend into an uptrend, or the other scenario where the market would break below the previous low into a lower low, essentially holding this low time frame downtrend. Now, as I said before, we don't try to predict the exact breakout, but we can know that there is a higher probability that we'll get the break above the past high, so that later the market can fill the supply from the daily chart. So we just wait, have patience, and react to what the market tells us. Here, for example, what happened is that it tried to move into a lower low, but it failed to do so. And instead, we've got equal lows from where a massive uptrend started happening in this 1-hour chart. This uptrend eventually closing above these highs, forming the trend shift from a low time frame downtrend into a low time frame uptrend. So it's actually right after this break where the uptrend is validated. Trend that looks to be holding on for longer, filling the supply, and having a near instant rejection to the downside with this bearish engulfing candle. That's basically a bearish candle that broke below the past candle. So we've used the daily chart for the analysis, the 1-hour chart to see the exact moment the market fills the supply, and now we're going to lower the time frame one last time into the 5-minute chart, or 15 minutes, on whatever time frame you want, and we're going to use this time frame to identify a potential setup. So this is the exact same price action, just seen on the 5 minutes chart. Every single time we lower down in time frames, we do a quick analysis of the swing points. For example, after filling the supply, the market reversed quickly to the downside, which broke the past swing low, turning it into a bearish trend shift inside this 5 minutes chart. So we went from having these higher lows into now having lower lows. And similar, we went from having higher highs into now potentially looking into forming lower highs. And that's what we should be expecting since we've got the break. After a break, a pullback will often happen, similar to what we've seen before, and a pullback in a downtrend is seen as an upside push just to fill a supply or resistance. From where we can take the market lower, that's simply just a bearish continuation. We got the pullback to the upside, but it didn't have enough strength to fill the supply, so we missed the trade, and that's fine, it's far better than forcing trades. The important factor is that we still broke below the previous low, forming the break of structure, which is validated only here, when we get a candle closure below this range. And this is an internal break of structure, because it's happening inside the lower time frame, not on the daily chart or the hourly chart. And now the process repeats, as I said before, after a break, expect some form of pullback. This pullback should form the lower high, which rejects back down from a supply, followed by a break of the previous low, which is actually just a continuation of the downtrend in this 5-minute chart. So planning the setup with a similar logic to the last one, a sell short position with an entry on the last supply, with the stop loss above the last high of the supply, and the take profit should usually be below the previous low. And if we need more data, we can zoom out, and we look for the past swing lows to be taken down, since we're now in a downtrend, and on downtrends, lower lows are expected to happen. We have the first one from the left of the chart, but there are a lot more, this being another one, and there is another one below, and actually a lot more depending on how low you think the market might go, and also depending on your risk tolerance, because targeting a lower level with the same stop loss target, this will increase the risk-reward ratio. Now, because we've hit the high time frame supply from the daily chart, and we're just reversed on the lower time frames, there is actually a good chance we might continue the downtrend from the daily chart, and that would push down the market into a lower low on the daily chart, which in this 5-minute chart would be a break below the extreme swing low. But I wouldn't be taking a setup with such a high ratio, because it's not realistic to sustain in the long term. If you still want to target the swing low from the daily chart, that can be done, but we should move the stop loss also on the swing high, or above the daily supply. And in that case, it decreases the risk-reward ratio to a more sustainable level. It also turns this into a swing trade. Let's see above the high. Now here it's the most I would target. A 1-to-5 ratio is also rare but doable, especially in situations where such deep analysis has been done. And now we just wait for the market. We see that it quickly moved into the supply, opening this position, and instantly rejecting to the downside right after it filled the supply. Now, because this is a swing trade, I will switch back into a higher time frame, just to see the price action moving faster. But it's still the same position, same targets, nothing changes. This is what we're seeing on the 4-hour chart. It would completely make sense if this turns into a winning position. Because look at what the market has done previously as well. A constant break of the previous lows. Looks like it's going straight down. Now we do have the pullback, and that's fine as it should end with a lower high. That later turns into a lower low, helping the position since it closed on a win, holding the daily time frame downtrend. Now a similar plan can happen again. A pullback to the upside to fill a supply, followed with a rejection. Now, of course, this won't happen forever, and at some point we will get the reversal by invalidating a supply. But as I said in the beginning, it's a lot harder to predict the moment of reversal, so we just look to trade with the trend instead. Now let's see on another market. This is on the 30 minutes chart. We do a quick analysis of the swing points and see a beginning of what it looks to be as a downtrend. But then bullish momentum kicks in, this breaking above the past high, but failing to break above the swing high, because if you look closely, it only wicked above, but did not close with a candle closure. This is actually a very bearish signal. It shows that this market might have been pushed higher just to take stop losses from these highs, and that's easily seen from the upcoming price action, coming with a very large bearish candle, and exactly after that bearish candle, the market turns into downtrend formations of lower highs and lower lows. Now, if we're having a bearish break of structure, which is basically just a break of the past low during a downtrend, similar to what we did on the last market, we expect a pullback, exactly like it happened before, even on this market. And where the pullback usually ends? Often on a supply, so we identify the supply in this recent structural range. And if you know the theory, it's simple to apply, the supply being the last bullish candle before the downside impulse, this being the main time frame supply. So we just wait for the market to see if it fills the supply, We invalidate the supply only if we go far away, and it looks like it's not going to come back to fill it anytime soon. But this probably won't be the case here, since the market looks to be consolidating right below. And here it did actually hit right into the supply, and look at the candles that form right away. 2 bearish candles. Rejection candles. If this supply would respect, the expectations would be to form lower lows on the higher time frame. That's bearish trend continuation. And after a break, you already should know the theory. Expecting a pullback to fill a supply, which would form the lower high, then rejection into a lower low, to continue the downtrend, and so on. So we do exactly what we've done on the last market. When the main supply fills, we switch into a lower time frame. This is the 15 minutes chart, and as I said, every time we lower in time frames, we do a quick analysis of the swing levels. Here we see that we've had higher lows and here we've had higher highs, these two forming some kind of ascending trend line that broke to the upside, giving the impression that an uptrend has started. But in reality, it only broke to the upside just to fill the main time frame supply. From where, as we can see, it rejected right back down, breaking the lower side of that trend line, also breaking down below the previous swing low from this 15 minutes time frame, which is the first break of the low, since before we've had an uptrending price action, and now we've had a lower low. That's a market structure shift inside this 15 minutes chart. And now a similar story repeats, as you should know by now, after a significant downside break, a pullback to the upside is often set to happen. So again, we look for a supply near the structural price action. Applying the theory, the supply is the last bullish candle before the downside impulse, which is this entire level. This is the supply from the 15 minutes chart, also called as an internal supply. So planning the setup from this internal supply as it follows, a sell short entry on the supply, and before placing the stop loss and take profit targets, you can zoom out in the price action to see the swing points. So we have here the extreme swing high, then we have a chain of repeated lower highs, up until the last one, which is the high from where we're taking the trade. So logically, knowing that highs should not break in downtrends, it makes sense for the stop loss to be placed above the recent lower high, so the next high is still a lower high, which should be filling the supply while opening the sell short position. And a similar logic for the take profit. If you look closely on the swing low formations, you see lower lows. So it would make sense if we would see another one being formed. So logically, that would mean the take profit could be placed below the past swing low, expecting another low to be formed. Now after placing, we look if the risk-reward ratio is decent, which in this case might be too high. We can decrease the ratio while still keeping the quality of the setup. For example, we can look for another exit target. One can be a possible demand that has not been validated. So demands are the last bearish candles before the upside impulse. But keep in mind this is not a valid demand because the market is a downtrend, and on downtrends it's supplies that respect, and demand zones usually invalidate. But we can use them as exit targets because there is also a possibility the market fills the supply, falls back down, moving closer to the take profit level, but then it bounces from this invalid demand, actually forming the first higher low, which would reverse this into an uptrend, which would stop us out of this trade. But because the take profit is right at the demand, if this price action would actually happen, we would already be out of the trade with the take profit being hit before the stop loss would happen. So we just wait and react to what the market is doing, but until then, patience, especially that it looks like the market already moved down into this possible demand, so let's see the reaction. And it broke down below. As I said, these types of demands don't respect. We just use them for possible exit targets, but not for entries. However, we still got some bounce to the upside. But its point is because the supply is up there, so buyers are pushing the market to exit on the supply. The supply fills, and we get an instant bearish reaction exactly on the candle that filled the supply, also closing this position pretty quick. Quicker than I expected. Within the next few candles it moves into the level of the take profit, and even lower. But still not below the swing low yet. Keep in mind this market is a downtrend, so as we've had here a low, then a lower low, we should be expecting the last swing low to break down again. It looks like it's going to do it, since these candles are constantly bearish with increased selling pressure. And here we've closed below the swing low, so we've had a swing lower high that filled this order. Then a swing lower low which continued this downtrend. It's really mostly about properly analyzing the swing points, because that's what show you the trend that has a higher probability of holding. Because you can keep doing this again and again. For example, this downside push formed a supply, if you looked at it from a higher time frame, supply that it filled right here with a wick, if we would also be looking at a higher time frame. And what's the result of it? A straight rejection to the downside from the supply. Now, of course, there are more concepts to apply so you can spot these setups with higher accuracy. Most of these concepts and tricks are inside my program that you can check it up if you're interested, because it helped a lot of traders, and it might help you as well.